You. Simon Khalaf is CEO of Marqeta. Simon, it's great to see you. Welcome.
Kelly, thanks for having me and having Marqeta on.
Do you think we're sort of fairly lumping all of these stocks together? I mean, is there some overarching kind of thing going on in your sector or no?
I think we're kind of swimming in a sea of red, as you've shown on your screen. And I'd say it is the tale of one city versus the tale of two cities. We ourselves have beaten every guidance we've put together, and the majority of our customers have done that. But if there is one entity in the sector that has not outperformed, the whole sector is pressured down. But as far as we're concerned, we have a lot of customers that are doing well, and they're shorting up the average U.S. consumer. So I think we're looking good.
So the customers are actually doing well. Tell us more about that.
Yes, I mean, I did hear your previous speaker about the lumpiness in the economy. We actually are not feeling it because a majority of our customers are actually helping the average consumer, and more specifically, buy now, pay later, and accelerated wage access. So the buy now, pay later companies that are powered by Marqeta are growing 36%, and now they are accounting for about 7% of the e-commerce market. And their growth did not come at the expense of increased defaults. So they're helping consumers kind of weather the perceptive storm, and they're doing well. The same thing with accelerated wage access. You've got 70% of the population that is living paycheck to paycheck. And if you accelerate the paycheck, they're not getting into the credit card debt, which is at 22%. And on top of that, you have 3.5% inflation. So I think our customers are helping, and that's driving the growth. So we're not seeing the softness that is in the market.
That's really interesting. The only counter I'd have to that is, our customers in the buy now, pay later and accelerated wage access, in other words, getting your paycheck right away, not waiting those extra few days, is their success right now, the fact that they're doing well precisely because the consumer's under pressure, itself some kind of warning sign?
I don't believe so. I mean, at the end of the day, if you look at the numbers, they're starting to become big. So let's say people estimate the buy now, pay later market to be $100 billion this year, and out of which about 50% is interest-free. So somebody's injecting a $50 billion loan to consumers without charging them interest, and the defaults are not growing. So I think it is opening up the credit box so the average American consumer can participate in this economy, and no matter what they hear from the media. I mean, we've been talking about a recession and inflation for 2 years. We've been scaring everybody for 2 years. But the good news here is the consumer appears to be resilient, and it's kind of like they turned their television station off and went spending and things, but they're not piling up the debt because most of the buy now, pay later loans are short-term loans, so they're in and out in 60 days. So I think that trend is healthy.
And would you know if so the main concern with buy now, pay later the last couple of years is it just kind of allows people to take on credit risk, and it's hiding future defaults, or we're not going to really see the full effects of defaults until the consumer really comes under pressure and then it explodes. I mean, I don't know if you'd have any window now into whether that's happening or what would happen to your company if at some point it did.
Yeah, good question. There's a lot of articles that are coming out about the phantom debt or what BNPL is doing in like to pile additional debt on the U.S. consumers. So, well, here's the good news. They have options. A revolver or a credit card is 22% interest rate, and BNPL is free. So the credit card revolves, and you're paying interest on interest, while in BNPL, you're in and out in 60 days. So no, absolutely not. We're not seeing any trend that buy now, pay later is actually sending the consumer into more debt because they're done in 60 days. Now they can try again, but the risk is significantly lower because they are not piling on debt. They actually, when they finish the last payment, and that's a moment of jubilation, then they start a new debt and they pay it again. So it's not compounding like the other debt that's available in the market.